Partnership distributions do not have to be equal. This is a common misconception about business partnerships that needs clarification. While many assume profits must be split evenly among partners, the reality offers much more flexibility. Partners can allocate profits unequally, provided this arrangement is properly documented in the partnership agreement. This flexibility allows partnerships to recognize different contributions from partners, whether through capital investment, expertise, or time commitment. There are 3 standard ways to take money out of a partnership. First, return of capital, which refers to payments back to partners that exceed the growth of the business. Second, distribution of income, which shares the net income between partners according to the partnership agreement. And third, loans to partners, which allow borrowing from the partnership capital. When it comes to allocating partnership income, several methods can be used. These include specified ratios, allocations based on partners' service contributions, or distributions according to partners' relative capital investments. The most common method is allocation based on capital investment. For example, if partner A and partner B each supply 50% of the capital, each typically receives 50% of the company's net income. However, unequal distribution of profits is perfectly allowable. A partnership agreement may specify that profit percentages are not dependent on capital contributions. For instance, partners could agree that despite equal capital contributions, one partner receives 40% of profits, while another receives 60%. These unequal distributions must comply with Internal Revenue Service rules to avoid problems. The key requirement is what the IRS calls substantial economic effect under Section 704B of the Internal Revenue Code. This means the allocation must be reflected in partners' capital accounts. Distributions upon liquidation must align with capital account balances, and allocations must have real economic impact on partners, rather than just being tax avoidance mechanisms. When partners borrow from the partnership, proper documentation is essential. This requires setting up a notes receivable account and preparing a promissory note that specifies the principal amount, repayment dates, interest rates, late payment penalties, and installment payment amounts. Regarding taxation, returned capital is not taxable. However, if you liquidate the partnership and receive more than your capital investment, the excess is considered capital gain. Conversely, receiving less than your initial investment results in a capital loss. Partners must calculate their tax basis both before and after receiving a distribution. Basis is reduced by the amount of cash or adjusted basis of property received. If a distribution exceeds the partner's outside basis, the excess is treated as a capital gain. Timing is crucial here, as basis must be determined immediately before the distribution. There are also special types of distributions with unique implications. Guaranteed payments are made to partners for services or use of capital, regardless of partnership income. Disguised sales occur when a distribution resembles a sale transaction. Non-liquidating distributions reduce a partner's basis without ending the partnership interest, while liquidating distributions fully extinguish the partner's interest. Even sophisticated partnerships make mistakes with distributions. Common errors include failing to track basis, ignoring disguised sale rules, incorrect capital account maintenance, and improper documentation. To avoid these pitfalls, partners should maintain detailed records and consult with tax professionals. Partnership taxation operates on a pass-through basis, meaning the partnership itself doesn't pay taxes, but the partners do. This applies even to retained earnings, profits generated by the business, but not distributed to partners. The IRS considers these funds as distributed for tax purposes, requiring partners to report them on their individual tax returns. A well-drafted partnership agreement is essential to avoid unintended tax consequences and disputes among partners. By clearly outlining distribution methods, allocation formulas, and procedures for special circumstances, partners can create a framework that supports their business goals while satisfying regulatory requirements.